Good morning, good morning, good morning. Happy Friday, 7th of February. It's the morning blast for myself and Mr. Michael Brown. We'll get the legals out of the way. So, as usual, nothing discussed on this space session constitutes trading or investment advice or infers any kind of endorsement by PIQ Global Limited, Trends PIQ or PIQ Suite, or indeed the hosts, which, as you know by now, is Mr. Michael Brown and myself, Mr. Ryan Paisley. Let's see if why has that not seemed to have worked. Right, let's have a look. I'm not showing anyone as being on the recording. That's normally very weird because normally people have joined by now. Let's just check on my phone. 1 second. Sorry if you can see or hear me, but I can't see or hear you. Okay, so I can see you on my phone. 1 second. Hello, Mr. Brown. Can you hear me now? I know because I haven't allowed you to talk yet, so that'll be why. 1 second. It's very weird. Nothing's showing up on my mobile phone. Sorry, on my computer. Co-host invite sent, Mr. Brown. Hello.
Hello, is there anybody there?
There is, but bizarrely on my computer, no one has appeared. It just looks like it's me on my own, so I'm just switched over to my mobile.
I can assure you it's not you on your own. We've got Mr. Rich Bernard is here, Paul is here. There's a whole host of people joining us.
I can see you now because I've switched to my mobile, but the computer instance was a bit funky, so I'm now on my mobile. So apologies if the sound is changed. What's been happening?
Well, I'm going to take it as a given that you've done the disclaimers already this morning.
Yeah, take it as a given.
Perfect. Good stuff. Well, good morning, everybody. Happy Friday. Happy Jobs Day as well.
Yay.
The January US labour market report due a little bit later on today. In terms of yesterday, though, it was a somewhat quiet day for financial markets more broadly. The S&P kind of just grinding steadily higher as the day progressed, with the index closing up by around about 0.4% on the day, incidentally notching its first back-to-back weekly gains in a fortnight. The conditions elsewhere were relatively quiet, treasuries going nowhere particularly quickly. And that sort of subdued nature of trade was mirrored by and large in the foreign exchange space as well, with the dollar trading pretty much flat for most of the day, and the only notable mover being the pound, which softened around about 0.5%, trading down to a low of 120, or ending the day at about 124.50. And this came after, well, what was, to be honest, a quite confusing decision from the Bank of England. The Monetary Policy Committee delivering a 25 basis point cut, lowering bank rates to 4.5% yesterday, as expected and as had been fully priced by market participants in advance of the decision. What was unexpected, though, was the vote split. Firstly, we had all 9 members of the MPC voting in favour of that 25 basis point cut. Expectations had been that there were going to be 1 or maybe even 2 dissenters in favour of keeping rates unchanged. In fact, we did have 2 dissenters, but in a more dovish direction, with 2 of the external Monetary Policy Committee members favouring a larger 50 basis point move. Those 2 members being external member Dingra and, surprisingly, external member Catherine Mann, who I'm sure listeners who are familiar with the Bank of England will know. As recently as last December, she was saying that there are still signs of inflation persistence, that 100 basis points of easing this year would be far too aggressive, and she was really staking her claim once more to be the Bank of England's uber hawk. She then, completely out of the blue, decides to become uber dovish and vote for a 50 basis point cut. So I'm not quite sure what's happened there, but we will.
Hang on. But she did. It was, I think it was Viraj that found the some quotes on it or something like that. But basically said the reason she's flipped from hiking to cutting is nothing to do with anything other than trying to save the gilt market.
Yes, which I actually wanted to get onto later on because I've got a bit of a rant brewing about the Bank of England actually. So yeah, just to wrap up what the bank said, they reiterated their policy guidance, saying that a gradual and careful approach will be followed going forwards. Careful is a new word, but I don't think you would need to read too much into that, to be completely honest with you. They also noted that focus remains on the risks of inflation persistence. On which note, the bank also unveiled their latest round of economic forecasts yesterday. The long and the short of it is growth expectations down, inflation expectations up. The MPC now expect CPI to peak at 3.7% in the third quarter of this year, compared to the previous peak of 2.8%, and that CPI will return to the 2% target in the first quarter of 2028. Governor Bailey at the press conference was talking about how a lot of these inflationary pressures are likely to be temporary and that they're driven by external factors. When have we heard that before? And look how badly that ended last time out. And that brings me on to the rant that I was going to have. Because what I think we have here with the Bank of England is an MPC that has forgotten what their job is. The mandate that they are given by the Treasury is to get inflation to 2% sustainably over the medium term. Their mandate is not to deliver rate cuts to try and prop up growth because of the government's fiscal ineptitude, and deliver rate cuts to try and get a control over the gilt market because the government left themselves no headroom when they delivered their last budget. And I think actually the MPC could be storing up more problems for themselves by delivering what was a dovish vote split and dovish-ish guidance, combined with forecasts that point to little short of stagflation, even if Governor Bailey himself doesn't actually want to use that word. So I think the BOE are between a bit of a rock and a hard place, but a rock and a hard place of their own making, and they certainly won't be getting any sympathy from me. Moving away from the Bank of England, a few other notable points from yesterday. We did have some better than expected jobless claims figures, worse than expected jobless claims figures out of the United States on both the initial and continuing metric, although it is worth bearing in mind that neither of those pertains to the January non-farm payrolls print, which is of course due a little bit later on today. In terms of headlines, quite a lot actually, particularly coming out of the United States. In the political realm, Bloomberg had a big interview with the new Treasury Secretary Scott Bessent yesterday. Some of the most notable lines include Bessent confirming that the US's strong dollar policy remains intact under President Trump. Slightly interesting, given that Trump actually wants a weaker dollar, but nonetheless, that is what the Treasury Secretary is saying. Bessent has also met with Chair Powell. He apparently had a constructive meeting with Jerome Powell and said that he is sure Powell will do the right thing, which I must admit does sound mildly threatening. On the Treasury front, Bessent said that he does not see any changes in issuance for the foreseeable future, which is broadly in line with the guidance from the quarterly refunding announcement, which we had out on Wednesday. Forgive me, it's been a very long week. Sticking with the fiscal side of things in the United States, the White House also yesterday outlined their priorities on tax to a whole host of Republican lawmakers. A lot of this is very much in line with the rhetoric that we heard on the campaign trail. So Trump wanting to implement this idea of no tax on tips, also wanting to end taxes that are paid on Social Security benefits and on overtime, and he wants to renew the tax cuts that he introduced in 2017, which of course expire in relatively short order. One thing that was interesting, though, is that actually, I think a few of Trump's larger donors are likely to be a bit annoyed with this proposal, because Trump is apparently also seeking to firstly close the carried interest tax deduction. Effectively, that relates to how private equity and fund managers are paid. If they're paid via carried interest, they pay less tax. The second is that Trump is also looking to close a whole load of tax breaks that are available to owners of sports teams. So that will be interesting to see how that one goes down. Sticking with the United States, a couple of things on the AI front. US lawmakers, they are apparently looking to ban DeepSeek from US government devices. Why the hell that isn't banned already, I do not know. But nonetheless, I think that just speaks to the broader direction of travel on that front. I mean, if you're not going to let a lawmaker have TikTok on their phone to film themselves doing a funny dance, then you really shouldn't let them have some sort of deep AI app as well. And on the subject of AI, Elon Musk's Department of Government Efficiency has apparently been using AI to sift through a whole host of sensitive federal information in order to target where they are going to deliver their promised spending cuts. Our resident AI correspondent, Tom Talks Cars, tells me that the Washington Post are making a bit of a mountain out of a molehill with that story, but nonetheless, it does seem one that is doing the rounds a little bit. And a couple of equity stories lastly, before I hand back to you, Ryan. Firstly, we had earnings out from Amazon after the close yesterday. Amazon did deliver top and bottom line beats, but we had a very soft AWS revenue figure and also quite poor guidance for the first quarter. They see net sales in Q1 between 151 and 155 billion. The street was looking for 159 billion on that figure. Amazon was down by as much as 7% after hours on that guidance miss yesterday. And lastly, Honeywell, obviously one of the big US aerospace firms, they are actually splitting up into 3 companies. This comes amid continued pressure from activist investor Elliott. So they will be Honeywell Aerospace, Honeywell Automation, and Honeywell Advanced Materials. Basically, what Honeywell are doing here is they've seen what General Electric have done and gone, we'll have a bit of that and hope it goes as well for us as it did for them. And at the moment, it seems like it is because they were up 6% on that news yesterday.
Nice. Well, thank you very much, Mr. Michael Brown. So quickly before I move on, as usual, just a quick shout out to, well, firstly, Cam for the Crypto Blast. It'll be out very shortly. Just a heads up as well as a reminder that this is the last day, hopefully, that Zach will be away on holiday, and the overnight news roundup will be back from Monday. Fingers crossed that he doesn't break his leg on his final day on the slopes. So just headlines that I picked up on this morning. Starting off in the macro space, authorities are searching for a Bearing Air passenger plane with 10 people on board that was reported missing while en route from, I'm going to try this one, Unalakleet to Nome in Alaska. That's according to Alaska's Department of Public Safety.
I thought Nome was a beer.
I thought it was something you stick in the garden. So we shouldn't be joking at this.
No, we shouldn't really, but
German exports rose in December, but industrial production fell more than expected, showing that the outlook for the Eurozone's largest economy remains anything but rosy. And as a reminder, orders lead production, so that orders number isn't great. Oil prices rose marginally in Asia trade on Friday, but we're on a track for a third straight week of decline, hurt by US President Donald Trump's renewed trade war on China and threats to tariff hikes or of tariff hikes to other countries. The Reserve Bank of India, the RBI, reduced its key repo rate on Friday for the first time since May 2020, aiming to provide stimulus to the sluggish economy, which is projected to grow at its slowest pace in 4 years during the current fiscal year. A couple of geopolitical headlines. Iran's supreme leader, Ayatollah Ali Khamenei, said on Friday that experience has proven that talks with the US are not smart, wise, or honourable. So good luck with that one. US President Donald Trump will meet with Prime Minister Shiba for the first time on Friday as the two allies, wary of China's rise, work to boost business and security ties while an escalating trade war threatens to rupture the global economy. Russian President Vladimir Putin and US Donald Trump have yet to discuss a possible meeting. This comes as there's obviously more and more talk of a ceasefire deal being proposed by Trump. If something was leaked in the Daily Mail yesterday, it's up to you if you believe that is what was really going on. But there's a lot of chatter going around at the moment that something might be brewing. US Secretary of State Marco Rubio will visit Israel and Arab states in mid-Feb. State Department official said this making his first trip to the Middle East after a widely condemned proposal by Donald Trump to displace Palestinians in Gaza. Some equity news. Online fast fashion. That's almost like quick service, isn't it, for McDonald's? Online fast fashion retailer Shein is set to cut its valuation in a potential London listing to around 50 billion, said 3 people with knowledge of the matter, nearly a quarter less than the company's 2023 fundraising value amid growing headwinds.
just
Companies Go on.
Oh no, go on. Finish what you're going to say, and then I'll jump in.
The company's business prospects have come under a cloud in recent days after the Trump administration said it would close the de minimis duty exemption in the US, ending an import rule that helps Shein and keep their low prices. Just for a bit of background on this, Shein and rival Temu together probably accounted for more than 30% of all packages shipped to the US each day under the de minimis provision. The US Congressional Committee on China said in the 2023 report, the measure, if those that don't know, exempted shipments of less than $800 from all import duties, and that loophole is now closed. Go on.
Well, I think if you spent $800 on Shein, you'd probably buy the whole bloody website. What I was going to say was, the rumours that they want to list in London, going back to a sort of favourite topic of ours and the ailing state of the London market. A few people have kind of held up the fact that we might be getting Shein listing in London as a sign that things are turning around. Just to clarify, firstly, I want the London market to turn around. Secondly, the only reason they're coming here is because the US have told them that they're not allowed to list there. So it's not exactly as if we're their first choice.
Yeah, no, exactly that. But don't believe the hype, basically. Funny enough, I've just seen a Reuters story whilst you've been talking. UK house prices jump as tax deadline looms. That's according to Halifax. House prices climbed 0.7% in monthly terms last month after falling 0.2% in December. That's above the 0.2% increase expected by economists in the Reuters poll. But moving on to back to some equity names. Porsche shares fell 7% in early Friday trade after the luxury car maker forecast a preliminary profit margin of 10 to 12% for 2025, far below expectations as it struggles to boost flagging sales and weak demand in China. Just on a sidebar, but Porsche related, I did see our good friend Polemic Payne on Twitter this morning post one of the kind of something that was hidden in the French budget that was kind of forced through yesterday was that I think it was something like 50,000 euros will be the tax on like the Porsche SUV coming forward now. So huge taxes on emitting cars in France. So that's going to hit luxury SUV makers like Porsche as well. But anyway, Meta chief executive Mark Zuckerberg was in the White House on Thursday for meetings, according to a White House official. I've not seen anything about what they were talking about, but I'm sure that will be released shortly if it's not already. Stellantis, the world's fourth largest car maker and French technology and artificial intelligence firm, Mistral have decided to expand their strategic partnership, in a move which Stellantis said will speed up its industry data analysis. Sticking with the car industry, electric truck maker Nikola is nearing filing for a bankruptcy. That's according to the Wall Street Journal, citing people familiar with the matter. They've been near bankruptcy for quite some time, so it's just kind of I'm waiting for someone just to kick them over the edge, to be honest. Company. The company shares fell 20% to 60 cents in extended trading last night.
And Nikola, the ones who years ago they came up with that lorry that was apparently electrically powered, and then it turned out the video was just them pushing it down a hill.
Yeah, no, that's exactly right.
Clearly, things haven't turned around since then.
Yeah, it was a slight slope. And finally, oh no, not finally, sorry. UK orders Apple to give it access to users' encrypted accounts. That's gone to the Washington Post. Oh God, delete your hard drive. British security officials have ordered Apple create a so-called backdoor, allowing them to retrieve all content any Apple user worldwide is uploaded to the cloud. Rather than break the security promises it made to users everywhere, Apple is likely to stop offering encrypted storage in the UK. That's according to a report citing an unnamed source. And finally, should have wrapped this up with the automobiles, really. Tesla has raised the prices of its Model X cars in the United States by $5,000 on Thursday, according to its website. The Model X all-wheel drive car will now cost $84,990, a jump from its previous price of $79,990. And the EV maker said, adding that the Plaid variant, which was priced at $94,990, was now at 99,990. I think this is quite an interesting one because they're raising prices, and at the same time, demand, but especially in Europe, is collapsing, and they're definitely being overtaken by BYD and the likes in Europe at least. So it's an interesting one. Maybe this is why Musk is so keen on the Texas Stock Exchange to float SpaceX, and then he can roll into that.
Yes, I think you could well be onto something there. Are you still there, Ryan? You just need to cut off.
I am
Oh,
here.
you are there. Oh, perfect. Are you done?
Back to you in the studio.
Cool.
Yeah, back to you in the studio.
Good stuff. All right, then. In terms of today, of course, all eyes are on the January US labour market report due at 1:30 this afternoon. In fact, the data docket before that report is relatively quiet. The only thing of note is that either at 9 o'clock or midday, we're not entirely sure, depending on which calendar you look at, the ECB will be releasing a whole host of research into where they think the neutral rate lies in the Eurozone, which is one for the purists, let's put it that way. In any case, on to that jobs report, which of course is due at 1:30 this afternoon. Headline non-farm payrolls are expected to have risen by 170,000 in January, a modest slowdown from the 256,000 pace that we saw in December, albeit a pace that would be broadly in line with the 3-month moving average of job gains. As always, the range of estimates for the payrolls print is a very wide one, from 105,000 on the downside to 240,000 on the upside, but leading indicators for the jobs number bode relatively well, with continuing claims having fallen by 40,000 between the December and January survey weeks. The ISM manufacturing employment gauge at its highest level since May, and the ISM services employment gauge at its highest level since September of 2023. That said, there are a few downside risks that are worth being aware of, including the impact of wildfires in California, the fact that the survey week saw a big snap of cold weather, which likely adversely impacted employment, particularly in sectors such as construction, and we also have the lingering impact of some industrial action in there as well. Meanwhile, the average hourly earnings are seen rising by 0.3% in January on a month-on-month basis, unchanged from the pace seen in December, which would drag the year-on-year pace marginally lower to 3.8% from a prior 3.9%. Unemployment, lastly, that is expected to hold steady at 4.1%, compared to the prior 4.1%, of course, because it's holding steady. The other two things to be aware of in terms of the release today is that given that it is the January print, we will also get the annual benchmark revisions. The revisions will be taking effect to the March 2024 employment level, as always. The BLS have already given us a preliminary estimate of this revision, which is likely to be negative 818,000, or at least that's what they thought it would be last September. So market participants are looking for a figure in that range. By and large, we know the payrolls figure is going to be revised lower, probably to the tune of about 0.5% over the last 12 months, which, yes, is considerably bigger than the 0.1% revision that we've typically seen over the last decade, but I don't think it's anything to get too worried about, although it will cause the usual suspects to come out saying that the job figures are made up and all the rest of it. In terms of the context around the jobs report, I think it's highly unlikely that the January labour market figures materially shift the needle for the FOMC. Of course, the Fed kept the Fed funds rate unchanged at 4.25% to 4.5% at the January meeting, while indicating that there is no hurry to deliver further rate cuts, as Jay Powell noted that they need to see either real inflation progress or some labour market weakness to unlock another move lower, with focus, of course, also remaining on President Trump's trade policies, as well as the committee continuing to gauge the impact of the 100 basis points worth of easing that was delivered last year. In terms of the reaction to the report, I think the first thing to bear in mind is that we are back in an age where we have commentary on the jobs report coming from the Oval Office, so there's probably likely to be a Truth Social post about the jobs figures in relatively short order, although the survey week for the payrolls number was before the inauguration, but don't expect that to stop Trump either claiming, well, if it's a good number, he'll claim credit for it. If it's a terrible number, it'll all be Joe Biden's fault. In terms of
this is the way. This is the way.
Exactly. In terms of the market reaction, I think the market participants will view the data broadly in line with how we've been trading US data of late, in that focus is on the underlying story as opposed to any potential dovish or hawkish policy implications. As such, I think good news is good news and bad news is bad news in terms of risk. And just for context, market pricing at the moment seeing around about a 15% chance of a 25 basis point cut at the March FOMC meeting, with the first 25 basis point cut fully priced by July and around 44 basis points of easing priced by the end of the year. In terms of other things to keep an eye on today, we do also have labour market figures due from Canada. That data will, of course, cross at the same time as the US employment print. Canadian unemployment seen rising to 6.8% in in January from a prior 6.7%, with the economy expected to have added 25,000 jobs compared to the 91,000 that the economy added in December. Money markets price around a 4 in 5 chance of the Bank of Canada delivering another 25 basis point cut in March, although of course focus for the BOC and for the Canadian economy remains primarily on tariffs as opposed to anything in terms of economic data. Other things to keep an eye on, we do have consumer sentiment data out of the States this afternoon. The University of Michigan's preliminary gauge for February, that's expected at 71.7 compared to the prior 71.1. And there are some central bank speakers to be aware of, including the Fed's Kugler and Bowman, who will both make remarks after the payrolls figure. The ECB Vice President Luis de Guindos, he is also due to be speaking, as is the BOE Chief Economist Hugh Pill, who might also be able to provide a little bit more clarity as to the BOE's thinking when it came to yesterday's policy decision. And that is your lot from me this morning and for this week.
Well, thank you very much, Mr. Michael Brown. Oh, hello, Mr. Nick Letts. It's early for him. That's effort over in Florida. For Mr. Michael Brown, thank you so much, everyone. As I mentioned before, full overnight news roundup from next week when Zach is finally back from his skiing trip. For those in the crypto scenes, check out Cam's Crypto Blast. It will be coming shortly. And yeah, next week, me, Michael Brown, will be back telling you everything that matters from Monday morning. If you are trading today, keep it tight. Whatever you're doing this weekend, I speak for Michael Brown when I say we wish you have a very safe and very excellent weekend.
Indeed.
And we'll see you Monday.
Indeed.
See you later.
Bye for now.
Bye for now.